Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. What an interesting setup I think we have in front of us beginning this week with the PCE deflator on Thursday, and then right into the employment number that following week, the March employment report for February. Coming out of Fed speak, that's been extremely consistent really since late last year. You look at the Chair Powell pivot, November, December, an extreme duration grab in the marketplace. And now market's trying to find some sort of a new range here. On the short end, we've been adhering to this sort of 470 to 475 level in terms of downside yield levels in 10-year rates in and around 430, 435. So far holding with a slight flattening bias. Now, in general, we have favored steepening themes. We did catch some of that move, less disinverted. But I think certainly if you listen to the Fed speak and you look at what the market is doing, which is very clearly, at least for now, pricing to the Fed's guidance from December of potentially 3 rate cuts for 2024, what we're seeing in terms of yield curve shape, I think short term actually makes sense. Certainly the longer the Fed stays on hold, potentially, that will also have further curve implications as we look toward the middle to end of 2024 into 2025. But short term here, you listen to speeches by Vice Chair Jefferson, certainly Fed Governor Waller. What's the rush? The Fed saying the risk of moving too soon is greater than holding on potentially for too long. So it doesn't take a lot to throw a little bit of a wrench into some of these monthly readings that we've seen with CPI and with the PCE deflator since early 2023 along into the end of 2024, giving the chair confidence toward the end of last year, and now getting one hiccup here to throw a wrench into the notion of the Fed being very cautious, wanting more good data over time. And now any type of sticky data in terms of inflation or even the employment picture here, if we do continue to get reasonable numbers and we can break down that employment picture between household and establishment, but if we do continue to print jobs here moving forward and these inflation numbers do show signs of being relatively sticky, it doesn't necessarily mean the Fed won't come down at some point in 2024, but that timeline keeps decaying. It keeps getting pushed out. So certainly March off the table. May now, the market is pricing out May. So within the next 2 weeks in this period of time, if we do get slightly higher inflationary numbers at the end of this week, looking at the employment number that following week, we will likely continue to push that timeline out for when this Fed could potentially come down in 2024. So we've got May, we've got June. The market is clearly focused on June. We have July and September, and then we move right into the election season, that November meeting, I believe the day after the actual election in and of itself, which we do think the Fed will likely want to steer clear of. So very interesting scenario here right now. In terms of overall rates, like I said, I think we're seeing a consolidation coming off the extremes of late last year. This backup in yields, given the fact that the Fed now clearly signaling once again higher for longer, makes sense with a slight flattening bias. On the ground this week, like we said, the key data point will be the PCE deflator. Continued watch here on the housing data as well, which we think will be important as the season opens up here and we move into the spring and summer months. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.